Hello folks, I'm L.A. Little and this is your weekly NeoTA wrap, where we take a look at these markets and we do it from a neoclassical perspective, each time asking ourselves what happened last week and what does it tell us about the coming ones. I do this show each Sunday evening live, or actually broadcast at or before 10 o'clock Eastern Time, archived on YouTube. It's under the channel L.A. Little if you'd like to subscribe. As far as what happened to these markets, well, you need only look at what happened to overseas markets to understand what happened to the domestic markets. Because what happened overseas was basically an orgy of buying last week. Here's the Hang Seng 8 shares, huge volume spikes. These things go to the moon. They rocket higher, 2,000 points almost, in basically 5 days. If you look at the Hong Kong, you've kind of got the same sort of action taking place there. And you can even see, areas like Korea where they haven't been able to get sustained rises, volume coming into those markets because now they look cheap. Japan still at highs, although that one looks to retrace. It did an over-under on Friday. It's over a swing point high, maybe a retrace retest. There are a few markets that are struggling a little bit more than those, the semiconductors in Taipei. But mostly, if you look around the world, if you go over to Europe, it's the same thing. The French, broke higher, started to stretch higher, and the German market joined them on Friday as well. And so it's basically it's a feeding frenzy, if you will, in overseas markets. And so when you come back and look at the domestic markets, they too ground higher as well. 1.6, 2.2, 1.7. The only one that didn't move was the Russell. And when we look at those indexes, you'll see why that's the case, because actually the Russell was the leader on the way up, and the Russell was already at the highs, sitting up here testing that breakdown bar. It was interesting because on Friday it actually finally, after 4 days of trying to test it, it actually tested it on Friday. It got over it, closed underneath it, had less volume. That's a failure on the Russell. And if that's any indication of what's to come, that says these markets are going to try to pull back this week. Now this week is earnings, and the earnings highly anticipated because they've been expected to be horrible. And so you have bad expectations, or at least poor expectations, yet these indexes are sitting at the highs. So either those expectations are rubbish and that they're really going to be better than we think, or this market isn't prepared for them. Now, you know what I think from what I just said, and that is that these markets have been pulled higher, and I'm talking about the domestic equities, have been pulled higher by the rest of the world. In other words, they can't sell off with the rest of the world making new highs day after day after day. Yet here we come into earnings, hanging at the highs. It's going to be a very interesting earnings season as a result. One of the things I've pointed out before, I'll point out again, is that these trading ranges that keep developing, and I've pointed this out because what typically happens is when you see the duration of the ranges getting more narrow, and when you see the width of those ranges narrow as well, what that tells you is that the market is trying to roll. In other words, as it's going up, it's really flattening out. Right? I mean, that's really what's happening. And when the market flattens out, it tends to set up the structures that can lead to larger losses, if in fact it does roll back over. Now, we haven't seen it roll yet. Matter of fact, it's anything but rolling. It's sitting at the highs as a result of what we just talked about, with overseas markets doing as well as they are. And of course, those markets are doing as well as they are because of central bank largesse in a big way. Both China, Japan, still Great Britain, Europe now, it's everywhere. And we've seen starting with Great Britain and the US, that if you do QE or if you do large infrastructure projects like China keeps doing and keep bringing rates down, you're going to see equity markets push higher because the currencies get devalued. And that devaluation necessarily pushes the equities higher because it takes more of that currency to buy them. It also goes up because there's expectations things are going to quote, quote, get better. In other words, the economy is going to start moving to some extent. Although what we have seen here is that movement is nothing like the kinds of recoveries that we've seen before. So, is it smoke and mirrors? Is it real? Well, my opinion is it is smoke and mirrors on the big picture. But yeah, there's some more economic activity as a result of what has taken place. It's just that you're borrowing from Peter to pay Paul. And at some point, there's no Peters left to pay Paul. And that's going to be the issue at some point. Question this week is what's going to happen when I look at these indexes, just the indexes themselves, and I want to go back to the S&P 500. The NASDAQ, the NDX, the Dow Jones, all of those aren't telling us anything. The Russell gave us a failure on Friday, and it gave you a failure on the daily. The S&P actually got over a key breakdown bar, did it with a little less volume, but it got over it. And so if the S&P stays over it, and the Russell actually joins it, or vice versa, if the S&P gets back under it, and the Russell can't get higher, coming into earnings which really start up on Tuesday, then we may have a tell before those earnings actually hit Tuesday morning. And so that's what we'll be looking at for tomorrow. When I come back here, I'm going to look at a little bit more in terms of some sectors, move over and look at some viewer questions, and of course we'll do the final thoughts at the end of the show. I'll be right back.
If you are serious about trading, TA Today's Tools is the perfect service to help you reach your trading goals. Go to our homepage and click Use Our Tools. Here you will find an overview of this amazing service we offer to our clients. One of the tools you will have access to is the TA Today charts. These charts visually map all the neoclassical concepts that LA writes and teaches about and is the perfect charting service for neoclassical traders. Learn the trend of a stock you're interested in and see this stock on all 3 time frames. To get started with a free 2-week trial, go to our homepage, click Use Our Tools, and then click the free trial button.
So as we come back here, one of the things that we can look at, as the week gets started and as the week gets rolling, is the breakdown bars, and I'm on the daily chart here on, in this case, the biotechs. That breakdown bar, that's where all the volume is, that's where the break was. If it gets over this, then, it can go back up and try to attack the top. And so as we see these breakdown bars, and those, the dates on almost all of them is the 25th. As we see those breakdown bars, those are the key test. Given where we are, those are the key tests right now. Those are the things that you can measure up against. And they're not in all the indexes, but they're in some. There's the IBB we just looked at. Here's the SOX. You can see it's farther up on this bar on the SOX. I think the financials have one if we look at it, and it's a ways to go up on it still. The industrials, which got a huge boost out of GE selling off assets, that one's up attacking and over it, actually got over it. So this one has, proven to go higher. So that one actually is going to try to get up into resistance. So that's one that's over it. And I'm just flipping through the list here. Here's the XLK. You can see how that's farther up as well. I believe the XLV is set up the same way along with the IBB. And yeah, at 25th bar is here. 74.62 has a little ways to go still. And I don't remember if the consumer had one. Yeah, it did, and it's over it. So those are on the sectors, that's what I'd be watching. The other thing we saw last week is we saw the IYT which is the transportation index, break down. It got under 2 swing point lows, broke with less volume on one more than the other, but it came right back up, right back up. It's doing the retest regen, and it's actually over it. In terms of this one, it's not over the larger one, which is the first one, so that's really the measurement, 157.57. But it's like, you can't break these things down, folks. They've tried and tried for years now to break this market down, and every time it gets close, something reaches out and saves it. You can see on the intermediate term time frame, it looked as if it was about to break and break in a larger way. In other words, the October lows would have became the target, but not so quick, right back up in there. So when I look at the sectors and I envision again what the indexes look like, it's a key week with earnings. We're going to break a range one way or the other in the next week or two, and probably within this week. And that range I'm talking about is that range, on the S&P 500, is on the, NDX, all of those. And I'll just go back to the S&P on the weekly. That top is up here at 2119, and we're trading at 2100 basically, 2102. So 17 points up. It's not that far. If you can break over that range, well, then you can put another range on top of it, right? And that still doesn't necessarily mean this thing's going to rock and roll higher, right? Because, folks, I don't think you can argue that this thing isn't trying to roll. It's continuing to grind, but it's just slowing down as it's going. Maybe it gets another push up here, and and it can go up a little bit more and set another range up here. But the rolling is trying to take place. It's just the rest of the world right now seems to be the big support. And if these earnings turn out to be much better than I expect and much better than the market expects, then they can stretch it again. I mean, they've stretched it many times before. So I wouldn't get too negative because the trends are still up. The point is that this market is not nearly in the shape, I'll go back here on the daily, it's not nearly in the shape that it was in. And yeah, what's really happening more and more is a lot of thrashing, right? Even when you get the breakouts, like there was thrashing, if you remember, there was a lot of thrashing back down here. When it got the breakout, what did it do? It gave it all right back up. Yeah, it got a good week and a half of run, but then before you know it, you're right back where you started from. And I suspect if this breaks out, right, it's going to be the same sort of thing. Yeah, you get up, you get over, and before you know it, you're right back down in it again. And I suspect this year is going to be more and more of that. And it's going to be more of this slow roll type action taking place. Let's look at viewer questions. Oh, before we do that, I want to look at one more thing here on the dollar. The dollar is trying to rock back up, and it too is coming back to its breakdown bar, which happens to be, on this case, there was one on the 20th, but also another one on the 18th. That's going to be the key one because over that, you're back at the top of the range. So as the dollar tries to climb back up into that area, that's going to be kind of the key area. What happens when you get there? Because if you look over at the euro, the euro is, it looks like all these are trying to build out sideways ranges before they push lower. The euro had a push down to 104.25 on Friday, got under it, back over it, right? That looks like the save. That looks like the euro is going to flatten out and continue this sideways trend. And if that's true, the dollar should do the same thing. And if the dollar does do the same thing and stays within this range, then even though it's elevated, and my goodness, we know it's elevated. If we go to the weekly, you can see how elevated it is. If it stays in that range, though, then this market, unless those earnings are horrible, then this market can, try to climb a little bit higher because it's quote-unquote used to that higher dollar at this point, even though it's made a huge run. So that's kind of the backdrop there. And then lastly, before we drop the OX markets, let's look at the weekly on the TLT, which is the bonds. Now the bonds, again, they could also support a further push in the equities if in fact they start to come back down. I don't know if they will. They tried to do it here and it failed, right? There was an ABCD structure to take it into this level. Now you kind of got another one that could take it even lower. But as we saw before, and we keep seeing over and over this year, projections just aren't projecting to their price points. So in other words, we had this projecting down to here, but what did it do? It got arrested right there and went back the other way. And for all we know, this might be a little ABCD structure to try to go that way. When you see failed projections, when you see indecision like we see this year, you know, it's thrashing. It's up and down, kind of no huge rhyme or reason. And it makes it very hard for anyone that's trading markets, you know, to actually be profitable. Because what it forces you to do is to, you know, stretch out your stops, which of course gives you more risk, especially if you do get a trend one way or the other and you're on the wrong side of it. Okay, we'll come back, do a viewer questions, and then our final thoughts. Be right back. Okay, taking viewer questions. One of them has to do with Apple. The question is you know, what is the likelihood of Apple coming back to test on a weekly that 119 area, which happens to be where the swing point high is? And if we look at it on the daily, that's also where the breakout bar was here. Top of that was 118.12. So on a daily, you can see that would be an ideal spot. The other thing you have on the daily is if Apple does start to move down, right? You got two swing point lows here. But Apple also two swing point highs. So that range, again, like we're seeing elsewhere, that range is pretty well defined. You get over it, you can certainly go test that high. You get under it, well, you can go test that swing point high on the weekly. And so Apple's set up to go either way on their earnings. Of course, I think their earnings are about a week and a half out. If we go to the weekly and look at it, that's the swing point high the gentleman's talking about, 119.75. It's been more than 6 bars now off this breakout. So that's a good thing, right? Because it got as low as 121. So that says that if it does come back, right, that should be a fairly high probability buy right into there. And so, you know, what's the probability? Well, right now the probability is actually more so, you know, if you leave the indexes aside, the probability is that this thing, because it has some volume at the top on the daily and the weekly, it could just as easily gravitate up there because it's right at the key spot here. You know, this bar's top is what's holding it back in the intersection between that and the price above it. So that 127.48, that low is 128.46. So roughly 127.5 to 128.5 is the key area. Where's it at? 127.10. If it can't get over that 127.5 to 8.5, you know, then yeah, it can grind back down here. And I suspect what's going to happen with Apple is what's going to happen with everybody, and that's going to be what does the market do with the earnings? In other words, when we start getting these big names coming out this week, how's this market going to react? If it reacts negatively, then all these companies are going to probably react negatively, or vice versa, they're all going to get pulled higher. I don't really have a probability to give you. I don't know. I really, you know, there's nothing in the charts that tell me, you know, is it going to get back down there or not? I can't tell you. I really can't. I'd be making a number up to give you one because I just don't see anything to tell me what exactly that number should look like. All right, so that's that one. Let's look at the other one. The other one has to do with, let me see, what is this? WBA. So this is Walgreens, Boots Alliance. Okay, so you had a big spike up. I'm on the daily. Question here is, seems to be getting or setting up a weekly support area that has not printed yet after the blow off top on earnings. And that blow off top, I'm assuming, was this bar. I haven't looked up the earnings, but I'm guessing it was this bar. So let's see what it looks like on the weekly. Yeah, Yeah, I don't know if that's a blow off top actually, but this chart looks pretty good. I mean, there's really nothing wrong with it. You had something back here. I'd probably go look and see what that was if I was trading it. What caused it to get hammered like that. But it came back, got over the highs, and has broken out. And on the monthly, it's the same thing, and it actually looks like a nice big ABCD structure on the upside. From way down here. That's a fairly large one. So this just looks like it's going to try to work higher. I don't see. I can't quite tell, but it looks like it's to there. I'd have to actually look at the numbers closer. It's a fairly large ABCD structure on the monthly. Let me go back to the daily and see one more time here. So the ABCD structure here is already completed and nothing else there. And on the weekly, it's also completed. Boy, two tough ones. I can't make a call on Apple for you. And on this one, you can't really buy it up here. You got to let it come back into this area. So yeah, you're just kind of stuck waiting and watching, in my opinion. I would not be buying up here. So that's kind of where those sit. That's it. I'm sorry not able to help you more there. I'll be back with the final thoughts. So as we come back here for the final thoughts, what I would argue that you need to do is to focus on what not to do. Not what to do, but what not to do. And what not to do this year and right now is to do what you've been doing, and that is to assume that this market is going to bail you out no matter what. This market is a thrashing market now. It's an indecisive market. It doesn't know what's going to happen. You've got dollar rising, you've got these big spiky moves back and forth. And if you're trying to play shorter term stuff and you're putting stops up tight, you're getting thrashed out over and over and over on both sides. You can't do that. And so that either means you got to widen your stops out, which itself is dangerous, or you got to play much shorter term on very specific trades that's set up, and forget the general stuff because the market's not bailing you out. And what I mean by bailing you out, I just want to give you one example, and I'm just going to take a recent Alcoa, which recently reported earnings. If you bought Alcoa expecting it, it to get bailed out, and you bought it back here, say at the $15, $16 mark, let's say, and it goes up, makes a new high, comes down, kind of gyrates, goes down, and you're saying, oh, well, this market will bail me out. I'm only down $1. Well, wait, I'm down $2. Now I'm $3 down now, right, on a $16 stock. That's a huge hit, right? That's not small potatoes. And if you're waiting on the market to bail you out and you just got bad earnings, this thing may go even lower. There's probably 25, 30, 40% of the stocks that are doing this now. They're not getting bailed out. Now, they're not all this bad, but it's not that case, where the rising tide is lifting almost every boat. The tide is just ebbing and flowing at best on the general markets, and it's not helping most individual stocks. Some are doing great, some aren't. The job is to find those things that are doing great and try to stay away from everything else. For example, if I go over and look at, let me see, oh yeah, we talked about gold last week. Here's a good example. I told members about gold on Thursday afternoon before the market closed. And it wasn't so much just gold. The way it was fading in here was really nice, right? It faded into the bottom of this, held, reversed. So that low was 114.54. It got down to 114.48, reversed, held up. And then when I went over and looked at the gold stocks themselves, they did the same thing. They faded into this big bar right there. That's a nice setup. That says you don't have to probably take much risk. Probably opens up, sideways to slightly lower at worst case, right? Or potentially gaps up, and that's what it did. That's the kind of trade you have to find, right? A nice setup that gives you a fairly decent probability that something's going to work in your advantage. You can make your money, and you can either take it right away, which some of them did on Friday, or you can say, you know what, this one actually has a decent chance of making an even larger run. Here's that retest regenerate zone. It's already attacked it once, almost twice. It's going to try to come back here and do it again. And if it does it, it potentially can get to the other side of it. So in other words, this thing could trade, on a conservative number here. It can trade to 20, potentially to 21. And you bought it, in this case, would have been, that close, which was about 19. So you could get as much as $2 on a $19 stock, which, I don't have to do the numbers for you, but that's 10% or more, right? That's a good run. And you can do that in a very short period of time. If you took the doubles and triples, which some of them did, you make even a lot more. But the point is that there's trades out there that are set up at various points in time where they look better, right? They look like they have more opportunity, and their risk is fairly small. In other words, you don't have to hang around with a lot of risk. It should move now. You don't want something that might move over the next week or two. You want something that potentially can move now. And that's the sort of setup you're looking for. So, I would leave you with the thought that this is not a market to treat like you have the last 3 years. It's not necessarily going to bail you out. And if this market does roll over, right, Lord forbid, if we actually do get a rollover, we're going to see a lot of damage done. And so with earnings coming up, it's not clear that it's going to roll over. It's certainly not clear that it's going to break out. As a matter of fact, nothing's clear right now. It's a lot of mixed signals. But it's about risk, folks. It's about money management, risk management. If you don't have a small footprint now and this thing goes against you, where are you going to pull the plug, right? Are you going to pull it right here? Are you going to pull it down here? Are you going to keep waiting? I mean, that's the sort of stuff that one has to decide up front. And if you haven't made those decisions, you need to make them now, because this market potentially can roll over. And if it does, I suspect the rollover is going to happen fairly fast because it's set up that way. Folks, have yourself a great night. Thanks for joining me. I'll be with you again tomorrow, and then Tuesday morning, the earnings are going to start hitting, and we'll see what they want to do. Have a great one. Take care.